Hi, welcome. This is Mary Ellen McGonagle, Senior Managing Director of Equities here at Simpler Trading with your weekly Edge show. Today, we are going to take a look at some of the more impactful news. We had a very difficult week, and we'll take a look at why that took place. Also, take a look behind the markets as well as at the broader markets, see where did we close the week, all with an eye toward preparing for next week and beyond. Last up, viewer question of the week, and it's all about should you invest in inverse funds. I'll go ahead and share with you historical precedent as well as a couple of those inverse funds that have been on the move. So from here, let's go ahead and take a look at that news. First up, on Wednesday, the Federal Reserve did come out and announce their raising of the Fed funds rate by 0.75%, and that was anticipated. What was not anticipated was the very strongly worded comments from Fed Chair Powell following that rate announcement, where he outlined again that consumers as well as the economy may very well feel some pain before the interest rate rising campaign is ended, and that of course pushed the markets lower. We also in response did see the US dollar jump to a near-term high on the news. Also in the data front, we did get leading index numbers, and they fell for the 6th month in a row, so that's giving a sense that the economy is slowing down. But we did also get news on Thursday that the labor market remains strong despite a slight uptick in unemployment claims. This is another hot button for the Federal Reserve. In addition to inflation, they want to get that labor force down and unemployment up. So last up, next week, we are going to see durable goods orders come out, consumer confidence, and then the final number for that second quarter GDP, which is anticipated to be negative, which will mean we've had 2 consecutive negative quarters for that GDP. And that is oftentimes a signal that we are headed for a recession. Also next week, a number of Federal Reserve officials will be on the speaking circuit. Their comments will, of course, be closely watched. So we're anticipating yet another volatile period heading into next week. So from here, let's take a look. Where did we close the week? And here we are with the daily price chart of the S&P 500. A couple of really important metrics that we want to pay attention to, and that is the fact that our momentum indicators remain in negative territory. This RSI on the daily chart of the S&P is now in an oversold position down below that 30. The relevance there is that historically, when we do get down there, at some point in time, you may see a very brief rally, such as this period in the beginning of February, but net, it is in a declining phase and negative. Faster moving momentum indicator, stochastics, also heading lower and below this 50, and it too is in an oversold position. Not uncommon. We've had other periods back here. Stochastics are a faster moving momentum indicator, and again, that general trend is negative. Let's take a look at where we closed the week for the S&P 500, because quite simply, we have areas of near-term support that are being very closely watched. So I'm going to go ahead and mark this chart up very quickly and share with you just what I mean. Your first area of potential support here is this mid-July low, and we did undercut that today. Let's go ahead and get that down in that proper position. Yes, so we did undercut that. The next area of possible support is this mid-June low, and we can see that we're not quite there. We got awfully close to it, but the markets did put a rally in place in the last hour, so we were able to not have that occur. A break below this mid-June is being very widely watched by the markets. A lot of people on the sidelines waiting to see how the market behaves at that level. as we move forward, I will share with you a weekly chart to give you a feel for how significant a break below that mid-low June low would be. So from here, let's go ahead and take a look at the underlying sectors in the S&P 500. Again, a very difficult period for the markets. Here we are with a view quite simply of the percent decline that took place among the 11 sectors within the S&P 500. And the relevance here is if we take a look at these groups here at this lower quartile that really underperform the markets, discretionary, real estate, materials, financials, each of these are economically sensitive sectors and areas so that they will be more responsive to talk that we could be headed for a recession. Energy fund down 9%. This is all about, again, recession fears and the outlook of reduced demand for oil due to a slowing economy. From here, we can take a look at a chart view of these 11 sectors. Not much to talk about here. We can see I'm adding this RSI, relative strength indicator. Quite simply, your relative outperformers are up here at the forefront, and we can see utilities and healthcare. Staples down here, but at least inching toward the forefront. These are defensive areas of the market and those that can perform okay in a bear market period. But you can see, let's just take a quick look here, because despite their ability to potentially outperform, you can see that this is the utility sector, XLU, is in a downtrend. That RSI below 50, trending lower, your MACD now in negative territory. So despite their defensive nature, their charts are telling a different story near term as it relates to their possibility to outperform. Moving along, we can share with you some of the more, certainly the weaker areas of the market, and real estate has really gotten hit quite hard. We can see this deterioration. This is all about, again, recession fears and a rising rate environment. So we are seeing a continued downtrend take shape here as we approach that June low, and it appears that we did undercut that. So from here, I am going to go ahead and share that longer term view of the S&P 500. It's going to be a weekly chart, and I'm pointing out a couple of things here. First up, we can see that the markets here over these last 2 weeks have had a very difficult period, and more importantly, keying in on these momentum indicators. The RSI now below 50, heading lower. Likewise with the stochastics. And the importance or relevance here is comparing the current environment to bear market periods, in this case the 2018 bear market and the 2020 bear market. We don't normally see an RSI turn negative on the weekly. That is not usual. We can see, however, this year is an exception. Extreme volatility, but certainly going into that bear market status here for the S&P, we did get that negative RSI and negative stochastics that were present back here, and we are re-entering that at this point. I mentioned the move toward this mid-June low and the significance of a break below that. And the reality is that there's not a lot in the way of near-term potential support should we see a break below this low. There's definitely an anticipation that if we very decisively break below on heavy volume, that we will definitely have further downside ahead. So from here, I do want to share with you some ETFs that are really quite helpful as far as informing you what is taking place and taking shape here in the broader markets. So again, 2-month daily price chart view. I've added that RSI. Let's take a look at the strongest relative area. And at this point, it is the US dollar. This is UUP, and you can see that it had this big gap up in response to the broader markets, certainly interest rates being on the rise. So I will share that with you. A lot of this is due to foreign funds flowing into the higher yielding U.S. Treasuries, and hence a big uptick. And I did want to mention that a rise in the dollar is negative for commodity stocks and also for emerging markets. So that is areas, also multinational companies that sell overseas, U.S. companies, will be negatively impacted as their revenue, their sales numbers will be lower because of that rise in the US dollar. Let's take a look at this other area. We talked about interest rates. This is the yield on that 10-year Treasury bond. We can see it's up here at about 3.7, super high level. And again, the impact here is that high growth stocks do not fare well in a rising rate environment, and quite simply, the broader markets as well are negatively impacted. Moving along, volatility had a spike or an uptick. Certainly today, we got up to that 32 level, very elevated, very high relative to areas when the broader markets are in a bullish phase. You will see that VIX and volatility index around that 16-18 level. So we are continuing to see a rise here, and a rising volatility index correlates with a drop in the broader markets. Let's move on, take a look at some of these other areas that were very negatively impacted. And this week, small cap stocks were down about 6.5%. So of the broader markets, it was hit the hardest. Small caps are riskier in the sense that they tend to be a bit more volatile because of their smaller market cap, and a decline further than the broader markets really brings home that concept of a risk-off appetite that is currently taking place in the broader markets. Other risk-off areas here that we can see that are getting hit, actually semiconductor stocks were down almost 6%, continuing to deteriorate. This is another highly economically sensitive area. As we see semiconductor stocks, this is telling us that demand for their chips and equipment is being viewed as deteriorating going forward. And as demand for chips fall, so does it implicate a recession or certainly a contraction in economic growth. So from here, I talked about utilizing some of these inverse ETFs as a way to potentially buffer what's taking place in the broader markets. So let's take a look. We were talking about semiconductors. So first up, I will share with you an ETF that is the inverse, but it is ultra short. When you see that tag in the name of that ETF, it is telling you that it is leveraged. It's not just a simple inverse. But more to the point, let's take a look at the chart here for SSG. You can see it has been on the rise, and then this week broke out of a flat base on Thursday on relatively high volume, and then a continuation rally. So from here, I am going to add a 5-day simple moving average. Similar to stocks, you certainly do not want to chase. A lot of these reverse or inverse ETFs have had these types of pops over the last 3 days. So we can go back with SSG and look at historical precedent when an ideal entry point might be. And of course, it will correlate with that SOXX. That's the first thing you will want to look at. And then from there, with this particular chart, a pullback to this 5-day simple moving average at 30.6 has been a good buy point going back historically. Another inverse ETF here that we can take a look at. I did mention to you that the rise in the US dollar will negatively impact emerging markets. This is EEV, and again, another ultra, so it is going to be leveraged, meaning it will move faster, not only to the upside, but to the downside if you get a pullback. But this is all about the emerging markets, and the emerging markets, India and so forth, are in a declining phase, and we can see this uptrend that EEV has been experiencing, hugging this 5-day simple moving average. We've gapped up today well above that 26 level that would at this point be an ideal buy point. We can see the MACD still has room to run, if I may, to the upside. And then last up, I am going to share with you a couple of consumer staples stocks that are really holding in quite well. They offer a high yield and very attractive charts. This is General Mills. The company came out with earnings this week that were strong. More importantly, management guided growth estimates higher going into the remainder of this year and into next year. The earnings news did push the stock out of this base on this gap up. Very heavy volume. We did see a continuation rally on Thursday despite a negative market. And then on today's dip, buyers did come in. Let's take a quick look at an intraday chart of General Mills, and you can see this super high volume that took shape after the release of their earnings. The stock skyrocketed up here to this high, and more recently on this pullback, you can see that buyers came in at the close today and pushed the stock above the 5 and 13 moving average. You did have that nice positive MACD crossover. However, I would need to see that RSI enter into positive territory in order to even consider any kind of very short-term trade. Given the broader market's backdrop, I would not be inclined to, but certainly any of you that are comfortable with intraday trading and taking on shorter term positions, that would be interesting. And then last up here is SJM, JM Schmucker, another consumer staple stock, and you can see it's in the throes of potentially forming the right side of a base. I would need to see this black line up through the red, indicating a nice bullish MACD crossover, as well as a continuation of this RSI here in positive territory. That's it for this week. Everyone have a wonderful weekend, and I'll look for you here next Friday.
Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.